The world revolves around commodities. From the fuel in your car, to your morning coffee, to your hot shower before bed, commodities affect us all. Commodities account for an estimated $52 billion in the global economy. The simplest way to think about commodities is as raw products that can be bought and sold, typically in large quantities. Think oil, natural gas, gold, silver, copper, wheat, soybeans, coffee, and sugar. Commodities are important because they are the building blocks of many industries and are used to create a wide range of products. They also play a role in the global economy, as changes in commodity prices can have a ripple effect across industries and countries. Commodities are generally standardized products, meaning that they are interchangeable with other products of the same type, and have a uniform quality and price. Uniform prices for commodities are typically established through market mechanisms, such as auctions or exchanges. These mechanisms bring together buyers and sellers to negotiate prices based on supply and demand. Spot prices are often established through open market trading on commodity exchanges or through private negotiations between buyers and sellers. These are the current market prices for a commodity, based on supply and demand at a particular point in time. Futures prices are prices for commodities that are agreed upon now, but with delivery and payment taking place at a future date. Futures prices are established through trading on futures exchanges, where buyers and sellers can trade standardized contracts for commodities. Index prices are average prices based on a range of different transactions in the market. Index prices are often used as benchmarks for the pricing of commodities in long-term contracts. The establishment of uniform prices for commodities is important because it allows buyers and sellers to have a clear understanding of the current market value of a commodity, and it helps to facilitate efficient trading and pricing of these goods. They are also typically traded on commodity exchanges, where buyers and sellers can trade futures contracts for these products. Shaping the global economy. Changes in commodity prices can have significant impacts on the global economy, as commodities are used as raw materials in the production of a wide range of goods and services. Here are some ways that changes in commodity prices can affect the global economy. Inflation. Commodity price increases can cause inflation by raising the cost of goods and services that depend on those commodities. For example, if the price of oil increases, the cost of transportation will go up, and that can lead to higher prices for goods that need to be transported, such as food and consumer goods. Trade balance. Changes in commodity prices can affect the balance of trade between countries. For example, a country that is a net importer of a particular commodity may experience a worsening trade balance if the price of that commodity rises, as it will have to pay more for imports. Investment. Commodity price changes can also affect investment decisions. For example, if the price of gold rises, investors may shift their investments towards gold or gold-related assets, which could lead to a decrease in investment in other areas. Economic growth. Commodity price changes can also impact economic growth, particularly in countries that are heavily dependent on commodity exports. If commodity prices fall, these countries may experience a decrease in export revenues, which could lead to slower economic growth. Overall, changes in commodity prices can have complex and far-reaching effects on the global economy, and these effects can vary depending on the specific commodity, the extent of its use in the global economy, and other factors influencing economic conditions. Now that we understand how powerful commodities are, it's time to get some of that value for yourself. There are several ways to invest in commodities. Futures contracts are agreements to buy or sell a specific commodity at a specific price on a specific date in the future. Investors can buy and sell futures contracts through commodity futures exchanges, such as the Chicago Mercantile Exchange or the New York Mercantile Exchange. Commodity ETFs are securities that track the price of a specific commodity or a basket of commodities. They can be bought and sold like stocks on stock exchanges and provide investors with exposure to the commodity markets without directly owning physical commodities. Mutual funds are investment vehicles that pool money from multiple investors to buy a portfolio of assets, including commodities. Commodity mutual funds invest in futures contracts, commodity-related equities, or both. Investors can also invest in physical commodities, such as gold or silver, by buying and holding them directly. However, this approach requires storage and security costs before investing in commodities. It's important to understand the risks associated with these investments. Commodity prices can be volatile, and investing in futures contracts can involve a high degree of leverage, which can amplify both gains and losses. It's recommended that you consult with a financial advisor before making any investment decisions. Commodities play a critical role in our modern economy. They are the raw materials that underpin many of the products we use every day, and they are traded on global markets in huge volumes. The prices of commodities can have a significant impact on the global economy, as well as on the financial well-being of countries and companies that rely on them. Investors have a range of options for gaining exposure to commodities, including commodity futures, exchange-traded funds, commodity-neutral funds, and physical commodities. However, it's important to remember that investing in commodities can be risky and requires careful consideration of the potential risks and rewards. Whether you are a producer, consumer, or investor, understanding the world of commodities is crucial for navigating the complexities of the modern economy.